It's the last payment, and you almost don't believe the number on the screen. Zero. Not paid this month. Zero permanently. The balance line simply gone. You've made this exact payment more than 300 times, and you assumed this one would feel like all the others, just with better paperwork behind it. It doesn't. Something in your chest loosens in a way you weren't expecting, and you won't be able to explain it to anyone who hasn't stood exactly where you're standing. My name is William, and there is one exact day sitting somewhere on your calendar right now, maybe 2 years away, maybe 20, when your mortgage statement reads zero for the first time. And until that morning arrives, almost nothing about your financial life fully makes sense the way it will the day after. Here's the part that should bother you. A meaningful share of people who get within a few years of that finish line never actually cross it. They refinance to pull cash out for a renovation. They open a home equity line for a wedding or a business idea. Each move resets the clock, quietly, without fanfare, and most of them never notice they've done it until they run the math decades later and discover they paid a mortgage payment for most of their adult life without ever once feeling what it's like on the other side of it. So let's talk about what's actually waiting for you over there, because it is not simply a bit more money each month. It is a genuine flip in how your entire financial life behaves, and almost nobody explains it to you in advance. Let me start with what carrying a mortgage actually does to every other decision in your life, because you've been living inside this so long you've stopped noticing it. Picture your mortgage as an anchor, not a burden exactly, a useful anchor, the thing that let you buy the boat in the first place. But an anchor, by definition, holds you in place, and every month, before a single other dollar in your life gets a job, that anchor gets fed first. Your raise arrives, and a slice of it quietly reports to the mortgage before you ever get to decide what it's for. Your bonus lands, and some competing plan in the back of your mind runs it against extra toward principal before it runs it against anything else. This isn't a complaint, it's just physics. An anchor holds the boat exactly where it's supposed to, and it also means the boat cannot go anywhere else the day that anchor lifts. The boat doesn't just float a little higher in the water, it becomes capable of moving somewhere entirely different for the first time since you dropped it. Now, the average American mortgage payment in 2026, principal, interest, taxes, and insurance combined, runs close to $2,800 a month in a lot of metro markets and comfortably over $2,000 almost everywhere else. Sit with that number for a second, not as a bill, but as a monthly decision that's been made for you automatically for years. That's not a small leak. That's closer to a second rent payment disappearing every month into an obligation you signed up for so long ago it barely registers as a choice anymore. Here's the felt experience nobody prepares you for, and if you're carrying a mortgage right now, this is going to land uncomfortably close. The stress of a mortgage isn't really about the size of the payment, it's about the fact that it's permanent, or at least it feels permanent for years at a stretch. A job loss with a mortgage still owed is a crisis. A market downturn while you're still paying it down feels like a threat to the roof over your family's head, even when rationally it changes almost nothing about your day-to-day life. That background hum of obligation, the one that never fully turns off no matter how good a month you're having, is not in your head. It is the actual measurable weight of debt sitting on a psychological system that reads any unpaid balance as an open threat. That feeling is real, and it is not a character flaw. It is simply what an anchor feels like from inside the boat. Let me walk you through a real account, the way it actually behaves year to year, because the ending surprises almost everyone who hasn't lived it. Meet a woman I'll call Renata, 41 years old, who bought a $340,000 home with a 30-year mortgage at a typical rate, and instead of just making the minimum payment, she committed to throwing an extra $400 a month on principal every single month without fail. In year one, her extra payment barely dents the balance. Interest eats most of every payment early in a mortgage's life, so her progress feels invisible, almost insulting compared to the money she's setting aside. By year 10, though, something starts to shift. The proportion of every payment going to principal instead of interest has quietly flipped, and her extra $400 is now accelerating a curve that's already bending in her favor. By year 18, instead of the scheduled 30, the balance hits zero. 12 years erased, purely by feeding the anchor a little extra every single month rather than the bare minimum the bank was content to collect from her forever. Here's the lying number that trips people up before they even try.
An extra $400 a month sounds like a rounding error against a $340,000 loan. It is not. Because of how amortization actually works, extra principal payments made early in a loan's life are worth dramatically more than the same dollar amount paid late, since every dollar of principal you erase early stops generating decades of future interest on itself. That's the part the bank's minimum payment schedule is not in a hurry to explain to you. It helps to think of a mortgage as having three distinct phases, because almost nobody names them, and naming them changes how the middle stretch feels. The first phase is the interest years, where the bank collects the bulk of its money and your balance barely seems to move no matter how faithfully you pay. The second is the crossover, the point where more of each payment finally goes toward principal than interest, and progress starts to feel real for the first time. The third is the sprint, where the balance falls fast, extra payments feel enormously powerful, and the finish line, once theoretical, becomes something you can actually see and count down to. Now for the scaling beat, because not everyone can throw an extra $400 a month at a mortgage, and the principal doesn't require that you can. If you can only manage an extra $100 a month, you still meaningfully shorten a 30-year loan, often by 4 to 6 years depending on your rate. If you can push $600 or $800 extra, you can frequently cut a 30-year mortgage down to 15 or 16 years without refinancing anything. The math scales to whatever you can actually contribute. What never changes is the existence of the crossover point itself, and the fact that reaching it faster is always worth more than reaching it slower. So here's the reveal, the actual mechanics of what flips the day that balance hits zero, dramatized inside Renata's real numbers. On the day her mortgage disappeared, that $2,100 monthly payment she'd been making for 18 years didn't vanish into thin air. It simply stopped having a job. Nothing about her income changed that month. Nothing about her expenses changed either, except for the single largest one on her entire sheet quietly going to zero. The next month, for the first time in nearly 2 decades, $2,100 showed up with no assignment, no anchor waiting to be fed first. That is the flip. Not a bonus, not a raise, not luck, just an obligation ending and the same dollars finally becoming hers to direct. Now for the tragedy data, because this is where the story gets genuinely sad if you sit with it. A large share of homeowners in this country are still carrying mortgage debt well into their 60s and 70s, a share that's grown meaningfully over the past 2 decades as people buy later, refinance more often, and pull equity out along the way. Financial research keeps surfacing the same pattern. Homeowners who refinance primarily to extract cash rather than to lower their rate routinely add years back onto their payoff timeline, sometimes resetting a mortgage that was 7 years from done back out to 25. Most of them can tell you exactly what the cash was used for. Very few of them can tell you what it cost them in years of anchor they voluntarily reattached.
Here's the fork, and it's the part of this story that should genuinely unsettle you. Picture 2 neighbors, same age, same year they bought identical homes on the same street. One of them, we'll call him Deshaun, sticks to the standard schedule and finishes his mortgage in year 30, exactly on time, exactly as planned. The other, we'll call her Priya, adds that same modest extra $300 a month from year 1 and finishes in year 21. For 9 years, Priya has been living with that anchor lifted, while Deshaun is still feeding his every single month. Run those 9 years forward. If Priya takes her freed up $2,000 plus mortgage payment and invests it for those 9 years at a historical average return, she builds close to $290,000 in that stretch alone. Money Deshaun's household simply cannot touch yet because his dollars are still reporting to the bank first. This decision seems small at the time. $300 extra a month feels almost trivial to write down on a budget. It was the opposite of small. It was 9 years of a life Deshaun hasn't reached yet. Now let's talk about what actually happens once you're standing where Priya is standing, because this is the part that genuinely looks unfair in your favor once you're on the far side of it. That freed up monthly payment, invested rather than absorbed back into lifestyle, behaves like a second worker who showed up the day the mortgage left. At a conservative 7% return, $2,000 a month invested for just 10 years becomes roughly $345,000. For 20 years, it crosses $980,000. Nothing about that requires a raise, a side hustle, or a lucky break. It requires that the payment that used to belong to the bank now belongs to compounding instead. There's also a quieter shift that happens the moment the mortgage disappears, one that has nothing to do with investment returns at all. Your entire risk profile changes overnight. A job loss that would have been a genuine crisis while you carried a mortgage becomes an inconvenience once the largest fixed obligation in your life no longer exists. A market downturn that would have kept you up at night suddenly matters less because your housing no longer depends on your portfolio holding steady. People who've paid off their homes describe this less as feeling richer and more as feeling less afraid, and that distinction matters more than almost any number in this video. The Freedom Fund research on this is consistent. Once housing is fully owned, the psychological floor beneath a household rises, even when the market above them is falling. Here's the redemption piece, because if you're staring down 30 years still owed and feeling like this entire video was written for someone else, it wasn't. The math doesn't punish a later start the way fear tells you it does. Someone who starts adding an extra $500 a month at year 15 of a 30-year mortgage still meaningfully shortens the remaining timeline, often by 5 to 7 years, because even mid-loan extra principal payments erase years of future interest that hasn't compounded yet. The crossover point doesn't move to punish you for arriving late to the strategy. It simply meets you wherever you currently stand and starts working from there. So here's what actually matters, practically, starting this week. First, if you're early in a mortgage, even a modest extra principal payment, $100, $200, whatever you can genuinely sustain, is worth dramatically more now than the same amount paid in year 20 because of how amortization front-loads interest. Second, if a windfall or bonus ever lands in your hands, run the real math on paying down principal against what that same money could earn invested elsewhere, because sometimes the mortgage rate is low enough that investing wins, and sometimes it genuinely doesn't, and the honest answer depends on your specific rate, not a blanket rule either way. Third, and this is the one almost everyone skips, decide right now, before any windfall or refinance temptation ever arrives, that you will not reset your own clock for a purchase that could wait or be funded another way. The equity you're building is not a piggy bank to be casually cracked open. It's the anchor slowly, deliberately being lifted, one payment at a time. If any of this made you go pull up your own mortgage statement just now, good. That's the discomfort actually doing its job, because most people carry this number for decades without ever once running what an extra $100 would actually do to it. Go back to that screen with the 0 on it, the one from the very beginning, because that's not really the ending of this story. That 0 is a door, not a finish line. The day after it, the exact same paycheck that used to answer to the bank first suddenly answers to nothing but you. For some of you, that day is decades away, and knowing what's actually waiting on the other side changes how you treat every extra dollar between now and then. For a lot of you, that day is closer than you think, sitting quietly a few disciplined years ahead of where the standard schedule says it should be. None of this, the amortization math, the crossover point, the freed-up payment compounding into a second income, means much without understanding the mechanics sitting underneath it. How interest actually works both against you while you owe and for you once you invest. How to run the real comparison between paying down debt and building wealth instead, based on your actual numbers rather than a rule of thumb repeated without context. That foundation is the real starting point, the one that turns a mortgage statement from a bill you tolerate into a countdown you're actually running. I put together a full breakdown of exactly that groundwork on this channel, and it's waiting whenever you're ready to stop feeding the anchor and start lifting it.